Welcome to Audio Growth Library, where timeless wisdom meets practical growth. Today, we dive deep into one of the most influential books on personal finance and human behavior, The Psychology of Money by Morgan Housel. This isn't just another finance book filled with numbers, charts, and formulas. It's a journey into the human side of money, the fears, desires, mistakes, and hidden behaviors that shape our financial lives. Because as Housel reminds us, financial success is not about how smart you are, but about how you behave. Think about it. Two people with the same salary can end up with completely different financial outcomes. Some lottery winners go bankrupt, while janitors and teachers retire as millionaires. Investors with average knowledge often outperform Wall Street experts. Why? Because money is not purely mathematical, it's deeply psychological. It's about patience, greed, risk, luck, fear, and most importantly, your relationship with time. In this audiobook-style summary, we'll explore every chapter in detail. Each chapter is packed with powerful lessons, unforgettable stories, and practical insights you can apply immediately to transform your financial mindset. You'll discover why no one is truly crazy about money, just shaped by their experiences, how luck and risk silently control much of financial success, why enough is the most powerful word in finance, the hidden magic of compounding and the dangers of greed, why wealth is not what you see, but what you don't spend, and how true financial freedom is not about Ferraris or mansions, but about control over your time and choices. By the end of this journey, you won't just understand money better, you'll understand yourself better. So get comfortable, put away the noise of the day, and let's step into the world of The Psychology of Money, a guide to mastering not just your bank account, but your behavior. Because remember, in the game of wealth, it's not the smartest who win, it's the most disciplined. Let's begin. Chapter 1. No one's crazy. Money is one of the most emotional and personal subjects in human life. The way we think about saving, spending, and investing is not built solely on spreadsheets or rational analysis. Instead, it's shaped by our personal history, the experiences we lived through, the environment we grew up in, and the economic events that left deep marks on us. Because as Housel reminds us, financial success is not about how smart you are, but about how you behave. Think about it. Two people with the same salary can end up with completely different financial outcomes. Some lottery winners go bankrupt, while janitors and teachers retire as millionaires. Investors with average knowledge often outperform Wall Street experts. Why? Because money is not purely mathematical, it's deeply psychological. It's about patience, greed, risk, luck, fear, and most importantly, your relationship with time. In this audiobook-style summary, we'll explore every chapter in detail. Each chapter is packed with powerful lessons, unforgettable stories, and practical insights you can apply immediately to transform your financial mindset. You'll discover why no one is truly crazy about money, just shaped by their experiences, how luck and risk silently control much of financial success, why enough is the most powerful word in finance, the hidden magic of compounding and the dangers of greed, why wealth is not what you see, but what you don't spend, and how true financial freedom is not about Ferraris or mansions, but about control over your time and choices. By the end of this journey, you won't just understand money better, you'll understand yourself better. So get comfortable, put away the noise of the day, and let's step into the world of The Psychology of Money, a guide to mastering not just your bank account, but your behavior. Because remember, in the game of wealth, it's not the smartest who win, it's the most disciplined. Let's begin. Chapter 1. No one's crazy. Money is one of the most emotional and personal subjects in human life. The way we think about saving, spending, and investing is not built solely on spreadsheets or rational analysis. Instead, it's shaped by our personal history, the experiences we lived through, the environment we grew up in, and the economic events that left deep marks on us. Because as Housel reminds us, financial success is not about how smart you are, but about how you behave. Think about it. Two people with the same salary can end up with completely different financial outcomes. Some lottery winners go bankrupt, while janitors and teachers retire as millionaires. Investors with average knowledge often outperform Wall Street experts. Why? Because money is not purely mathematical, it's deeply psychological. It's about patience, greed, risk, luck, fear, and most importantly, your relationship with time. In this chapter, Morgan Housel introduces a profound phrase that summarizes this understanding. No one's crazy. At first, that might sound odd. Haven't we all seen people make what looks like completely irrational financial choices? People who take out loans they can't afford, sell their stocks during a market crash, or spend every dollar they earn without saving for tomorrow. To us, those decisions may look foolish, even reckless, but to them, it might make perfect sense. Why? Because every single person approaches money through the lens of their own experiences, and those experiences can be vastly different from ours. The story of two generations. Imagine two people. Person A was born in 1950. By the time they entered adulthood in the 1970s, they had lived through the booming post-World War II economy, when wages were rising, the stock market was growing steadily, and jobs felt relatively secure. Their personal experience taught them that the world is a place of economic opportunity, that the stock market grows wealth, and that taking financial risks is worth it. Person B was born in 1930. Their childhood was defined by the Great Depression, when banks failed, jobs vanished, and families lost everything overnight. By the time this person became an adult, the scars of financial collapse had shaped their worldview. To them, risk is dangerous. Stock markets are gambling tables. Saving cash is safer than investing. Now imagine these two people giving each other financial advice. Person A tells Person B to invest heavily in stocks, ride out the ups and downs, and trust that the market always recovers. Person B, however, insists on keeping money in cash, avoiding debt, and being conservative at every turn. Who's right? Both are, from their perspective. This is the essence of the chapter. No one's crazy. We're all just shaped by our unique experiences with money. Why our financial worldview is limited. Housel makes an important point. What we know about money is not shaped by history books or economic data. It's shaped by what we've personally lived through. Consider this. If you grew up during a booming stock market, you probably think of investing as a smart and safe strategy. If your earliest memories of money are tied to seeing your parents lose everything in a crash, you may view investing as a dangerous gamble. If you experienced high inflation in your youth, you'll always worry about rising prices eating away your savings. If you never saw inflation up close, it may never cross your mind as a serious threat. The world is too big and too complex for any one person to fully understand. So instead of relying on global knowledge, we rely on personal experiences, which form only a tiny fraction of the financial universe. Example, stock market returns. Housel highlights how this bias plays out in investing. Between 1970 and 1990, the U.S. stock market delivered strong returns. Anyone who invested during that period would likely conclude that stocks are the best way to grow wealth. But for someone in Japan, during the same years, the story was totally different. After the peak of Japan's stock market in 1989, the market crashed and stayed stagnant for decades. An investor in Tokyo would have walked away with a totally different conclusion, that the stock market is risky, unreliable, and best avoided. Same era, same world, but different countries, different lessons, different beliefs. Why this matters in daily life? Here's the key takeaway. Because everyone has a different financial history, everyone makes decisions that seem rational to them. That means when we look at others' choices, whether it's a friend buying a luxury car, an investor selling stocks too early, or a relative hoarding cash, we shouldn't immediately call it crazy. They're simply responding to their unique experiences. And the reverse is true too. Others may look at our decisions and think we're the ones irrational. This realization is humbling. It shows us that money isn't about right or wrong in the absolute sense. It's about perspective. The danger of judging others. One of the biggest mistakes in finance is assuming that because someone makes a decision we wouldn't make, they must be wrong. Chapter 2. Luck and Risk. If there's one truth about money that most people underestimate, it's this. Success is never only about skill. Luck and risk play a massive role in every financial outcome, far greater than most of us want to admit. Morgan Housel devotes this chapter to unpacking the uncomfortable reality that your financial life is often shaped by forces outside your control. Understanding this truth doesn't just make you more humble, it makes you more resilient, less judgmental, and far wiser with your money. Idea alert. The story of Bill Gates and Kent Evans. In the late 1960s, a teenage boy named Bill Gates attended Lakeside School in Seattle. This school was one of the only high schools in the world that had a computer at the time. Remember, back then, computers were not sitting in every classroom or living room. They were massive machines that only government labs or elite universities had access to. But Lakeside, through a series of unusual events and generous donations, managed to acquire one. That meant Gates, as a teenager, had access to a technology that would later define the rest of his life. It's no exaggeration to say that without this early exposure, Gates might never have become the co-founder of Microsoft or one of the richest men in history. His brilliance was real, his hard work undeniable, but his environment, the sheer luck of attending that particular school, played a critical role. But here's the other side of the story. At Lakeside, Gates had a close friend named Kent Evans. Kent was just as smart, just as curious, and just as ambitious. The two of them dreamed together about building companies and changing the world. By many accounts, Kent was every bit as capable as Gates, but in his late teens, Kent died in a mountaineering accident. His life, and all the potential it carried, was cut short by pure bad luck. So we see two lives shaped by forces beyond their control. Bill Gates had the extraordinary good luck of being in the right school at the right time. Kent Evans had the tragic bad luck of an early death. The lesson is clear. Financial outcomes are always part skill, part luck, and part risk. Why we struggle to see this? Humans love neat stories. We like to believe that successful people got there because they were smarter, more disciplined, or harder working. While those things matter, they're never the whole story. Luck, being born into a certain family, growing up in a certain era, meeting the right people at the right time, plays a huge role. The same is true of failure. We often blame people for being careless or irresponsible with money, but sometimes they were simply in the wrong place at the wrong time, victims of recessions, layoffs, illness, or accidents. Ignoring luck makes us arrogant. Ignoring risk makes us judgmental. A wise person sees both sides. The Russian roulette analogy. Housel uses an analogy. Imagine 6 people, each play Russian roulette one time. 5 survive, and 1 dies. Would you say the 5 survivors made smart choices? Of course not. They were simply lucky. Their survival had nothing to do with skill. Yet in finance, we often mistake survival for skill. A risky investment pays off, and we credit the investor's genius, not their luck. A risky bet fails, and we blame the investor's stupidity, not the role of chance. Lessons from Warren Buffett. Consider Warren Buffett. He is one of the greatest investors of all time, no doubt. But even Buffett admits luck played a role. He was born in 1930 in America, just as the U.S. stock market was about to enter the greatest bull run in history. Had he been born in another country, or in another century, his talent might not have had the same impact. That doesn't diminish his skill, but it highlights that skill alone isn't the whole explanation. The dangers of ignoring luck and risk. When we ignore the role of luck, we overestimate our own ability. Success makes us believe we are smarter than we really are. Underestimate others' struggles. We assume failure means weakness, when often it means bad luck. Take on too much risk. We forget how fragile success can be when chance turns against us. This leads to arrogance, envy, and reckless behavior, all of which are enemies of long-term financial health. How to think about luck and risk. Housel suggests a balanced approach. Respect the role of luck in success. Respect the role of risk in failure. Don't judge people too quickly, because their circumstances may be radically different than yours. The truth is, every great outcome requires both skill and luck. Every bad outcome involves both mistakes and risk. Separating the two completely is impossible. Practical usage tips from Chapter 2. Stay humble in success. When things go well financially, remind yourself, skill played a role, but so did timing and luck. This keeps your ego in check and prevents overconfidence. Stay compassionate in failure. Don't look down on others who struggle financially. Sometimes they faced risks they couldn't control. This builds empathy and humility. Avoid all or nothing bets. Don't assume that because something worked once, it will always work. Respect the randomness of outcomes. Spread your risks. Focus on process, not outcome. Judge your financial decisions not by whether they win or lose, but by whether they were made with sound reasoning and risk awareness. Remember Kent Evans. Success stories like Bill Gates are celebrated, but for every Gates, there are countless Kent Evans, talented people whose stories turned out differently. Always account for the unseen side of luck. Closing thought on Chapter 2. Chapter 2 reminds us of a sobering but liberating truth that you're not fully in control of your financial destiny. You can tilt your odds in your favor through discipline, patience, and strategy, but chance always has a say. Recognizing the roles of luck and risk doesn't make you powerless. It makes us wiser. It teaches us humility when things go well, resilience when they don't, and compassion towards those whose stories turned out differently. Because in the end, financial life isn't a clean equation. It's a messy mix of skill, luck, and risk, and the wisest players respect all three. Chapter 3. Never Enough. If there's one word that has destroyed more fortunes, reputations, and lives in the world of money than any other in the world, it's this: more. Morgan Housel opens Chapter 3 with a chilling reminder that many of the most financially successful people in history have lost everything, not because they didn't have enough, but because they couldn't recognize when they did. This chapter is about the danger of endless pursuit. It's about why the inability to define enough can ruin even the wealthiest, and why finding your own sense of sufficiency is one of the most powerful financial skills you can ever master. Idea alert: the story of Rajat Gupta. One of the most striking examples Housel shares is the story of Rajat Gupta. Gupta rose from poverty in India to become the managing director of McKinsey & Company, one of the most prestigious consulting firms in the world. Later, he sat on the boards of major corporations like Goldman Sachs and Procter & Gamble. He was a billionaire by every standard of success. But he wanted more. In 2008, during the height of the financial crisis, Gupta was convicted of insider trading. Despite already being incredibly wealthy, he passed confidential information about Goldman Sachs' financial decisions to hedge fund manager Raj Rotharam. Why? To get in on trades and make even more money. The result? Gupta lost his career, his reputation, and his freedom. He served time in prison, all because the wealth he had wasn't enough. This story is shocking, not because Gupta needed money. He didn't. It's shocking because his desire for more blinded him to the risks. When more becomes a trap. It's easy to look at someone like Gupta and shake our heads, but the truth is, many of us fall into smaller versions of the same trap. A person earning $60,000 dreams of making $100,000. Once they hit $100,000, they want $200,000. At $200,000, they want $1 million. At $1 million, they want $10 million. And so the cycle continues. The problem isn't ambition. Ambition drives growth, innovation, and progress. The problem is comparison. The endless chase happens when we measure ourselves against others, neighbors, colleagues, celebrities, and find ourselves coming up short. The real danger: there's no finish line. No matter how much you earn or achieve, there will always be someone richer, smarter, or more successful. If you can't define what enough looks like for you, you'll never stop running, and eventually you'll run off a cliff. The story of Bernie Madoff. Another extreme case of never enough is Bernie Madoff, the man behind the largest Ponzi scheme in history. Madoff had built a successful and legitimate business. He was wealthy, respected, and admired on Wall Street. But that wasn't enough. He wanted more returns, more admiration, more power. So he started fabricating profit. Chapter 4. Confounding Compounding. Albert Einstein once called compound interest the eighth wonder of the world. Whether or not he actually said it doesn't matter. The truth remains: compounding is one of the most powerful forces in finance. And yet, despite its power, most people struggle to truly grasp it. We understand addition, we understand multiplication, but exponential growth, money that grows on itself over decades, is so unintuitive that our brains often can't fully process it. In Chapter 4 of The Psychology of Money, Morgan Housel takes us deep into the world of compounding, why it's misunderstood, how it works invisibly in the background, and how patience is the secret ingredient that turns ordinary decisions into extraordinary wealth. The Warren Buffett example. When you think of compounding, one name always rises above the rest: Warren Buffett. Buffett is often celebrated as the greatest investor of all time. People look at his wealth, over $80 billion, and assume his success is purely about genius-level stock picking. But here's the overlooked truth: Buffett's fortune is less about his skill and more about his time. Buffett started investing when he was just 10 years old. By age 30, he had about $1 million. Impressive, yes, but nothing compared to what came later. Today, nearly all of Buffett's wealth, more than 99%, came after his 50th birthday. Let that sink in. Decades of steady compounding, not magical yearly returns, made him rich. His average annual return has been about 22%, which is phenomenal, but not otherworldly. There are hedge fund managers who beat that for a decade or two. The difference? They didn't keep at it for 75 years. Compounding isn't about getting the highest return. It's about getting pretty good returns and sticking with them for the longest time possible. Why we struggle with compounding? Because humans think in linear terms. If I tell you to walk 30 steps, you can picture exactly how far you'll go. But if I tell you to take 30 exponential steps, where each one doubles the distance, you'd circle the Earth multiple times. That's the shocking nature of compounding. It's slow at first, almost invisible, and then suddenly explosive. This is why so many people quit investing too soon. The early years feel disappointing. Growth seems too small to matter. But over decades, the curve bends upward in ways that look almost magical. The ice cube analogy. Housel gives a powerful analogy. Imagine an ice cube sitting in a cold room. The temperature slowly rises. 25 degrees, 26, 27, 28, nothing happens. At 31 degrees, still nothing. Then, at 32 degrees, the ice begins to melt. Suddenly, everything changes. Was it the 1-degree difference between 31 and 32 that caused the change? Not really. It was the gradual buildup of all the degrees before that. That's how compounding works. Progress is often invisible until one day it becomes unstoppable. Why people quit too early? One of the greatest mistakes investors make is quitting before compounding had had the chance to work. Think about retirement savings. In the first 10 years, your account might grow slowly, perhaps from $10,000 to $25,000. It feels small. But over 30 to 40 years, the curve bends, and suddenly you're looking at hundreds of thousands, even millions from the same contributions. The tragedy is that many people pull out too soon because they don't see instant results. They forget that compounding is less about the short-term growth and more about letting time do its work. Patience is the secret ingredient. What makes compounding powerful isn't the rate of return, it's the time horizon. Consider two investors. Investor A earns 20% annually but invests for only 10 years. Investor B earns 8% annually but invests for 40 years. Who ends up wealthier? Investor B, by a long shot. Why? Because the length of compounding outweighs the rate of compounding. In other words, time greater than rate. The psychology behind it. Housel argues that compounding isn't just a math problem, it's a psychology problem. It requires patience, faith in the long term, and the ability to delay gratification. Our brains crave quick results. We want to see progress now, but compounding asks us to trust that small, consistent actions today will lead to massive results tomorrow. It's the same in health, relationships, and personal growth. Eating a single salad won't transform your body. Reading one book won't make you wise. But over years, the effects multiply. Stories of compounding in action. The Quiet Millionaire. Many ordinary people who start early, save consistently, and let their money grow end up with massive fortunes, not because they earned high salaries, but because they gave compounding time. The missed opportunity. On the other hand, countless stories exist of people who jumped in and out of the market chasing quick wins. They often underperform, even those with high skill, because they cut compounding short. Practical lessons from Chapter 4. Start early. The most important factor in compounding is time. Even small amounts invested in your 20s can grow larger than big amounts invested in your 40s. Be patient. Compounding rewards endurance. Don't get discouraged by slow progress in the beginning. It's supposed to look that way. Stay consistent. Small, steady contributions beat occasional big investments. Think long-term habits, not one-time windfalls. Don't interrupt the process. The biggest risk to compounding is pulling out too soon. Avoid panic selling during downturns. Think beyond money. Compounding applies to knowledge, health, and relationships. Small, consistent investments in yourself and others grow exponentially over time. Closing thought on Chapter 4. Chapter 4, Confounding Compounding, teaches us one of the most vital financial truths. Wealth isn't built by extraordinary skill or lucky timing. It's built by ordinary discipline applied consistently over decades. Compounding is the closest thing we have to financial magic, but only for those patient enough to let it work. As Housel reminds us, the real genius isn't in finding the fastest path to wealth, it's in staying on the path long enough for time to do the heavy lifting. Chapter 5. Getting Wealthy versus Staying Wealthy. Money is a two-step game. The first step is getting wealthy. The second step, often harder, is staying wealthy. Most financial advice focuses on the first part, how to earn, invest, and grow money. But Morgan Housel argues that keeping wealth requires an entirely different mindset than building it. It's not just about skill, but about survival. This chapter dives into why making money and keeping it are two very different skills, why luck and risk always play a role, and why humility and caution are often more important than brilliance. The Tale of Jesse Livermore. To illustrate the difference, Housel shares the story of Jesse Livermore, one of the most famous stock traders of the early 20th century. Livermore made a fortune by shorting the stock market during the crash of 1929. At the time, newspapers called him the Great Bear of Wall Street. He walked away with $100 million in profit, equivalent to billions today. He had done the impossible. While millions of investors were ruined, he became unimaginably wealthy. But here's the tragedy. Within just a few years, Livermore lost it all. He gambled recklessly, chasing bigger wins, convinced his talent could outsmart risk itself. By the end, his fortune was gone. Devastated, he took his own life. Livermore's story is a chilling reminder. Getting rich and staying rich are two different games. The key to staying wealthy, survival. Housel argues that staying wealthy requires a survival mindset. It's not about constant brilliance or taking bold risks. It's about humility, frugality, and an almost paranoid sense of caution. He sums it up simply. Getting money requires risk-taking, optimism, and courage. Keeping money requires the opposite: humility, fear of loss, and a respect for luck. You have to survive first before you can thrive. The role of luck and risk. Why is survival so important? Because luck and risk are always in play. Luck can make you wealthy faster than you imagined. Risk can wipe it all away in a moment. Even if you're smart, hardworking, and disciplined, events beyond your control can upend everything. Markets crash, pandemics hit, technology shifts. That's why humility is so important. Recognize that no matter how skilled you are, chance always has a seat at the table. Keeping wealth, behaviors that matter. So how do you actually stay wealthy? Housel identifies a few key behaviors. 1. Frugality. Wealth doesn't survive reckless spending. People who continually live just below their means preserve their safety margin. 2. Humility. Avoid assuming you're smarter than the market or immune to mistakes. As Livermore's story shows, overconfidence destroys wealth. 3. Flexibility. Stay adaptable. A rigid plan that ignores risk is fragile. The wealthy who endure are those who can adjust to changing conditions. 4. Fear of risk. Not paralyzing fear, but healthy caution. Wealth is fragile when people underestimate how quickly things can turn against them. The money paradox. There's a paradox to money. To get rich, you need to be bold, optimistic, and willing to take risks. To stay rich, you need to be cautious, humble, and sometimes even pessimistic. This paradox explains why so many people rise quickly, then fall just as fast. They keep playing the getting rich game, even after they've won. Think of it like climbing Mount Everest. Getting to the top is hard, but more people actually die on the way down. Why? Because they keep pushing past their limits, forgetting the real goal, not reaching the top, but returning home alive. The same is true for money. The real goal is not just getting wealthy, but keeping your wealth safe enough to serve you throughout your life. Why survival creates opportunity. Here's the beauty of survival. If you can just stay in the game long enough, compounding will eventually make you wealthy. Even if your returns are modest, survival ensures you'll be around to enjoy the benefits. The biggest fortunes aren't built overnight. They're built over decades of just not blowing up. This is why the richest investors often seem boring. They don't chase fads or gamble recklessly. They prioritize resilience over flashiness. Everyday lessons from staying wealthy. Don't over-leverage. Borrowing too much magnifies risk. If markets turn against you, debt can erase years of progress overnight. Have a margin of safety. Always prepare for things going wrong, because eventually they will. Know when enough is enough. Many fortunes are lost because people kept pushing for more. As we saw in Chapter 3, recognizing enough protects wealth. Diversify. Don't put everything in one asset, business, or bet. Spread your risks so no single failure can ruin you. Remember, wealth is what you don't see. Staying rich isn't about flaunting your success, it's about ensuring you'll never need to. Stories of staying power. The Rockefellers. John D. Rockefeller built one of the greatest fortunes in history, but what's often overlooked is how his family preserved it across generations, through trust structures, diversification, and conservative management. Everyday millionaires. Many people who retire wealthy aren't flashy entrepreneurs or genius investors. They're ordinary workers who lived below their means, saved consistently, and avoided catastrophic mistakes. They didn't just get money, they kept it. Practical applications of Chapter 5. Adopt a survival-first mindset. Always ask, what decision keeps me in the game the longest? Value consistency over brilliance. You don't need to win big, you just need to avoid losing big. Respect luck and risk. Never assume your success is fully your own. Be grateful, stay humble, and plan for setbacks. Define your exit. Know when to stop chasing and start protecting. Define what enough looks like for you. Protect your wealth like a fragile asset, because it is. The more you respect its fragility, the more likely it will last. Closing thought on Chapter 5. Chapter 5 of The Psychology of Money reminds us that money is a lifelong game, not a short sprint. Anyone can get lucky once, but true financial greatness belongs to those who can survive long enough to let time and compounding work in their favor. As Housel writes, getting money is one thing, keeping it is another. In the end, wealth isn't just about boldness, it's about balance, knowing when to take risks and when to protect what you've built. Chapter 6. Tails, you win. If you've ever flipped a coin, you know the odds, heads or tails. Half the time you're right, half the time you're wrong. But in investing and in life, success doesn't always follow a neat 50-50 pattern. In this chapter, Morgan Housel shows us that much of wealth creation, innovation, and progress doesn't come evenly distributed. Instead, it's driven by a handful of outliers, rare, extraordinary outcomes that account for the majority of results. In other words, tails drive success. The power of outliers. Think about the stock market. Thousands of companies are listed, but historically, a tiny percentage of them account for nearly all long-term market gains. From 1926 to 2016, just 5% of companies accounted for all net wealth creation in the U.S. stock market. The rest, on average, they broke even or lost money. This is the essence of tails you win. A small minority of investments drive the majority of rewards. It's the same in venture capital. Out of 100 startups a VC invests in, 80 may fail. 10 may do okay, and 1 or 2 may become unicorns that pay for everything. It's not about being right all the time. It's about being positioned when those rare tails show up. The story of Amazon. Take Jeff Bezos and Amazon. When Amazon launched, it sold only books. Many critics thought it was a ridiculous idea, a small online bookstore competing with giants like Barnes & Noble. But Bezos wasn't betting on books alone. He was betting on the internet becoming a major force in commerce. Over the years, Amazon launched countless projects. Many failed, like the Fire Phone. But a few, such as Amazon Web Services, AWS, became tails so powerful they changed the course of the company and the world. Bezos famously said, "Our success at Amazon is a function of how many experiments we do per year, per month, per week, per day. Most experiments fail, but when the tails hit, they more than make up for the failures." The psychology of rare events. Humans struggle to understand this because we're wired to expect balance and fairness. If we fail 8 out of 10 times, we assume we're doing poorly. But in fields driven by tails, like investing, business, and creativity, failure is not just expected, it's required. Housel puts it simply. You can be wrong most of the time, but if you're right once in a spectacular way, that one win can pay for all the losses and more. The Walt Disney example. Walt Disney faced failure after failure. His first studio went bankrupt. Many early films lost money. But then came Snow White and the Seven Dwarfs, a tail event that changed the animation industry forever. Later, movies like Cinderella, The Lion King, and the creation of Disneyland became tail events that built the Disney empire. Disney's story shows that tails often look crazy at first, but they redefine industries when they succeed. Why this matters in investing. When you expect every stock to succeed, you'll be frustrated. The reality is, many investments will underperform. A few will overperform spectacularly. Those few will drive the bulk of your wealth. This is why diversification matters. You don't know which tail will appear, but if you're spread out, you're more likely to catch one. It's also why long-term patience is critical. If you quit after a string of failures, you may miss the rare winner that changes everything. Practical lessons from Chapter 6. Expect failure. In tail-driven fields, most attempts won't work. That's normal, not a sign of weakness. Diversify widely. Since you can't predict which investment, idea, or project will become the tail, spread your bets. Keep experimenting. Like Bezos, view failures as part of the process. The more experiments you run, the higher your odds of hitting a tail. Don't give up too early. Tails often take time to appear. Compounding and patience increase the chance of catching them. Embrace uncertainty. Accept that rare, unpredictable events drive most success. Don't waste energy trying to forecast perfectly. Beyond money, life and career. This principle applies beyond investing. In careers, many job applications may lead nowhere, but one opportunity can transform your life. In relationships, many interactions may be forgettable, but one meeting could lead to a lifelong partnership. In personal growth, dozens of books may leave little impact, but one can change your worldview. The world is tail-driven. Progress depends not on average results, but on extraordinary outliers. Closing thought on Chapter 6. Chapter 6, Tails You Win, teaches us to embrace a world where most things fail, but the few that succeed more than make up for it. Wealth, innovation, and even happiness are often built on the back of rare, unpredictable wins. Instead of fearing failure, welcome it as the cost of admission to catch the tails. Because in investing, business, and life, you only need a few right decisions to change everything. Chapter 7. Freedom. What does money really buy? Most people assume it's luxury, cars, houses, vacations, or the ability to impress others. But Morgan Housel makes a bold claim. The highest form of wealth is freedom. Not freedom in the political sense, but freedom over your time. The ability to wake up and decide how you'll spend your day. To control your schedule. To choose work you enjoy or no work at all. That's the ultimate dividend of wealth. The true value of money. We often think of money as a tool for consumption. But consumption quickly loses its shine. A new car feels exciting for a month, maybe a year, before it becomes just another vehicle. A bigger house fills with clutter just like the old one. What never loses value, though, is the ability to control your time. Housel argues controlling your time is the highest dividend money pays. The power of autonomy. Studies consistently show that people are happier when they have autonomy over their work and life. Workers who can set their own hours report higher satisfaction. People who choose their projects and tasks feel more motivated. Retirees often describe freedom, not wealth itself, as the best part of financial independence. Time is the one resource you can never get back. Money's greatest power is buying it back. The billionaire's irony. Ironically, many wealthy people lose freedom chasing more wealth. They work longer hours, manage more stress, and end up with less control over their time than before. Imagine a CEO earning millions but tied to endless meetings, obligations, and a calendar filled by others. Compare that to someone making a modest income but working 3 days a week with afternoons free. Who's richer? According to Housel, the latter often has more true wealth because they own their time. The lottery winner study. Psychologists have studied lottery winners. Initially, they're ecstatic, but within a year or two, many report lower happiness than before. Why? Because sudden wealth often creates obligations, demands from friends, pressure to manage money, and loss of purpose. Contrast this with those who build wealth gradually and use it to gain control of their lives. They experience higher satisfaction because they use money for freedom, not just status. Practical lessons from Chapter 7. Redefine wealth as time. When evaluating financial goals, ask, will this give me more control over my time? If not, it may not be true wealth. Beware of lifestyle creep. Don't trade freedom for obligations by upgrading too quickly. More spending often reduces freedom, not increases it. Invest in flexibility. Save and invest not just for retirement, but for the ability to make choices today. Say no more often. Freedom grows when you stop saying yes to every demand on your time. Money gives you the cushion to do this. Measure success by autonomy. Instead of asking, how much do I earn, ask, how much control do I have over my time? Closing thought on Chapter 7. In Chapter 7, Freedom, Morgan Housel reframes wealth not as a number in your bank account, but as the ability to live life on your terms. The real luxury isn't a car or a house, it's waking up every morning knowing your day belongs to you. Because in the end, the highest dividend money pays isn't status, security, or even comfort. It's freedom. Chapter 8. The Man in the Car Paradox. Imagine driving down the road. You see a person in a shiny new sports car, a Ferrari, Lamborghini, or Porsche. What's your first thought? Most people don't think, wow, that driver must be amazing. Instead, they think, if I had that car, people would admire me. Here lies the man in the car paradox. The admiration we think we'll receive from others rarely comes. Instead, people project admiration onto the object, not the owner. Why we want expensive things. We buy luxury items to earn respect, admiration, and status. We assume others will look at us and think highly of us. But here's the twist. When people see someone with luxury items, they don't admire the person. They admire the thing. See a fancy car? You think about you driving it. See a designer watch? You imagine your wrist wearing it. See a huge house? You picture your family living inside. In reality, few people admire the person who owns luxury goods. They admire the lifestyle those goods represent for themselves. The paradox in action. A wealthy man pulls up in a Ferrari. The crowd doesn't think, wow, he must be smart, hardworking, and successful. Instead, they think, if I had that Ferrari, people would think I'm smart, hardworking, and successful. The admiration never transfers to the owner, it bounces back to the observer. That's the paradox. The endless chase for status. This paradox fuels an endless cycle. People buy luxury to gain admiration. Others don't admire the buyer, only the object. The buyer feels unnoticed and buys more luxury, hoping it'll work next time. This creates a treadmill of consumption that rarely leads to fulfillment. The real source of respect. True admiration doesn't come from material possessions, it comes from character. Think about the people you respect most in your own life. Maybe it's a parent, a mentor, a friend. Chances are your respect for them has little to do with what they own. Instead, it's about their kindness, wisdom, resilience, or integrity. Luxury goods can signal wealth, but they rarely signal character, and it's character that creates lasting respect. The role of status in human nature. Seeking status isn't irrational, it's wired into us. For centuries, status helped people survive. High status meant better access to resources, protection, and mates. But in the modern world, this instinct often backfires. Buying symbols of status doesn't guarantee real respect. It only feeds the illusion of admiration. Stories of the paradox. The silent billionaire. Many of the world's richest people live quietly. Warren Buffett still drives a modest car and lives in the same house he bought in 1958, yet he is admired globally, not for his possessions, but for his wisdom and philanthropy. The flashy spender. On the other hand, we see celebrities or influencers flaunting expensive cars and clothes. They may attract attention, but do they attract respect? More often, people envy their things, not their character. How to escape the paradox. Recognize the illusion. Understand that admiration rarely attaches to you through possessions. Don't expect respect to come from what you buy. Shift focus to character. Invest in being someone worth admiring, not just someone with things worth envying. Practice modesty. Modesty signals quiet confidence. People often admire those who don't need to flaunt wealth. Spend for yourself, not others. Buy things because you enjoy them, not because you hope others will admire you for them. Practical applications. Before making a luxury purchase, ask, am I buying this because I love it or because I want others to notice it? Invest your money in experiences, education, or time freedom, things that bring lasting fulfillment, not fleeting admiration. Remember that most people are too focused on their own lives to think deeply about yours. Don't spend money to impress an audience that isn't really watching. Closing thought on Chapter 8. In Chapter 8, Morgan Housel exposes a truth most people never consider. We don't admire the person in the fancy car. We admire ourselves imagining being in the car. So instead of chasing admiration through possessions, chase respect through character. Because in the end, people don't remember the car you drove. They remember the kind of person you were. Chapter 9. Wealth is what you don't see. Walk through an expensive neighborhood. You'll see grand houses, luxury cars, and manicured lawns. You might think, wow, these people must be rich. But Morgan Housel flips this assumption on its head. What you see, the cars, the jewelry, the designer clothes, is spending. True wealth is what you don't see. Spending versus wealth. The fancy car in the driveway, that's money that's gone. The luxury vacation photos, that's money already spent. The $20,000 watch, that's not wealth. It's proof that wealth was converted into consumption. Real wealth is invisible. It's the money not spent. It's the savings account, the investments, the cash reserves, the resources quietly compounding in the background. The problem with visible riches. People confuse being rich with being wealthy. Rich is a current income. It's visible. Wealthy is hidden. It's assets not consumed. When we admire someone for their visible riches, we often forget that the true measure of financial security is what remains unseen. Why this matters? Admiring visible spending can lead us into traps. We try to imitate what we see, not realizing that what's visible is often the least important part. We may stretch ourselves financially to appear rich, while destroying our ability to become wealthy. This is why people earning huge salaries can still be broke, because they spend everything to maintain the appearance of success. Story: The Millionaire Next Door. Thomas J. Stanley's classic book, The Millionaire Next Door, found that real millionaires often live modest lives. They drive reliable cars, not flashy ones. They live in average houses, not mansions. They quietly build wealth through saving, investing, and compounding. Meanwhile, those who flaunt riches often have little left behind the curtain. Housel's core point: wealth is financial assets that haven't yet been converted into things you can see. A car is not wealth. It's a depreciating asset. A house is partly wealth, but often more a liability when oversized. True wealth is freedom, security, and options, the unseen power of money left unspent. The social illusion. We often admire people who look rich, but ironically, those people may be the farthest from true wealth. The $200,000 car in the driveway may belong to someone drowning in debt. The modest-looking neighbor may have millions in investments quietly compounding. Housel stresses, don't confuse the illusion of wealth with actual financial strength. The trap of consumption. Why do we spend on visible luxuries? Status signaling. We want others to see we've made it. Instant gratification. Spending feels good now, saving feels invisible. Social proof. If others are flaunting, we feel pressure to keep up. But consumption eats away at the very thing that creates wealth: savings and compounding. The quiet power of saving. Every dollar saved has two values: the immediate security of knowing you didn't spend everything, and the compounding potential of that dollar to grow into many dollars in the future. What you don't spend is more powerful than what you do. Real-world examples. The modest investor. Ronald Redd, a janitor and gas station attendant, quietly saved and invested throughout his life. When he passed away, he left behind $8 million, not because he flaunted wealth, but because he consistently built it quietly. The flashy spender. Countless celebrities earn millions, yet go bankrupt. Their spending destroys the unseen wealth that could have secured their future. Practical applications. Redefine wealth. Stop equating wealth with consumption. Remember, what you see is often the opposite of real wealth. Celebrate saving. Every time you choose not to buy, you're building invisible wealth. Learn to take pride in what's unseen. Build financial invisibility. Invest in index funds, retirement accounts, or real estate that quietly grows in the background. Resist social pressure. When tempted by flashy purchases, remind yourself, admiration for spending is shallow and fleeting. Real wealth is freedom. Closing thought on Chapter 9. In Chapter 9, Morgan Housel reminds us of a profound truth. Wealth is not the Lamborghini on the street or the mansion on the hill. Those are signs of money that's already gone. True wealth is invisible. It's the quiet power of money unspent, working silently in the background to secure your future. So the next time you admire someone for what they own, pause and ask, what don't I see? Because that's where the real story of wealth lives. Chapter 10. Save money. There's a famous saying, wealth is not about having a high income, it's about having high savings. Morgan Housel takes this idea further in Chapter 10. He argues that saving money is not just a financial strategy, it's a behavioral superpower. It's the bridge between wanting wealth and actually building it. Why saving matters. You can earn a high income and still be broke if you spend everything. You can earn an average income and become wealthy if you save consistently. Income determines how fast money flows in. Savings determine how much stays. Wealth, at its core, is created not by earnings, but by retaining what you earn. The illusion of high income. People often equate high income with success, but Housel reminds us, income buys you opportunities, savings buy you freedom. Without saving, income is fragile. It disappears the moment the job, contract, or career ends. The psychology behind saving. Why don't people save? Lifestyle creep. As income rises, expenses rise too. Social comparison. Pressure to keep up with peers leads to overspending. Delayed gratification. Saving feels invisible and less rewarding than spending. Saving requires patience, humility, and self-control, qualities not easily visible in society. Stories of saving. The humble saver. Ronald Reed, the janitor who left millions behind, is a perfect example. He didn't earn much, but he saved diligently. His modest lifestyle allowed compounding to work its magic. The high earner trap. Countless professional athletes earn tens of millions, yet go bankrupt after retirement. Why? They never saved. High income fooled them into believing money would always flow in. Why saving is a hedge. Housel calls saving a hedge against life's inevitable uncertainty. Markets crash, jobs are lost, health emergencies strike, unexpected opportunities rise. Savings turn these events from crises into manageable challenges. They buy you resilience. The power of flexibility. Saving isn't just about security, it's about options. Want to quit a job you hate? Savings make it possible. Want to take a career risk? Savings buy you time. Want to help a loved one in need? Savings provide the freedom. In Hausel's words, the flexibility and control over your time is the highest dividend money pays. The simple math of saving. You don't need a complex formula to start saving. The key lies in one principle. Spend less than you earn, save the gap. Even small savings grow large through time and compounding. Saving $5 a day may feel small, but over decades it becomes transformative. The earlier you start, the less you need to save thanks to compounding. Cultural problem. Spending to signal wealth. One of the biggest obstacles to saving is the cultural pressure to spend in order to look successful. Fancy cars, designer clothes, luxury vacations, these are signals. But often, they signal the opposite of wealth. They show money that's already gone. By resisting this trap, savers quietly build true financial strength. Saving without a clear goal. A common mistake is believing you must save for something specific, a house, retirement, a car. Housel argues differently. You don't need a reason to save. Save because the future is uncertain. Save because flexibility is valuable. Save because opportunities appear when you least expect them. Think of saving as building optionality, the ability to make choices later without knowing today what those choices will be. Practical applications. Automate savings. Set up automatic transfers to savings or investment accounts. What you don't see, you won't miss. Prioritize savings over status. Choose the invisible power of savings over the visible illusion of spending. Start small, scale up. Don't wait until you can save big. Begin with small amounts and let consistency compound. Redefine wealth. Take pride in how much you save, not in how much you spend. View saving as freedom. Instead of framing savings as sacrifice, frame it as buying control over your future. Closing thought on Chapter 10. Chapter 10 makes a simple but profound point. Saving is the foundation of wealth. It's not flashy, it's not visible, and it doesn't win applause. But it quietly builds freedom, resilience, and opportunity. In the end, your savings determine whether you work because you want to or because you have to. So save not just for retirement, not just for emergencies, but for the priceless dividend of freedom.
Chapter 11. Reasonable is greater than rational. When it comes to money, most people are told to be rational. Follow the numbers, stick to logic. Don't let emotions interfere. But Morgan Housel argues something counterintuitive. Being reasonable with money is more powerful than being purely rational. Because humans aren't robots. We don't make decisions in a vacuum of spreadsheets and formulas. We live in a messy world filled with emotions, fears, ambitions, and uncertainty. And in that world, a merely reasonable plan is far more likely to succeed than a perfectly rational one that no human could actually stick with. Rational versus reasonable. Rational means doing what's mathematically optimal, even if it feels uncomfortable. Reasonable means doing what makes sense emotionally and practically, even if it's not perfectly optimal on paper. For example, rational investors might put 100% of their money into stocks, since historically they yield the highest returns over time. But most people can't stomach the gut-wrenching drops during market crashes. A reasonable investor balances stocks with bonds or cash, not because it's mathematically optimal, but because it keeps them invested long-term. In finance, sticking with a good enough plan beats abandoning a perfect plan. Story: The Great Depression Generation. Housel points to people who lived through the Great Depression. Rationally, they should have invested heavily in stocks once the economy recovered. But emotionally, many never trusted markets again. Instead, they kept large amounts of money in savings accounts, CDs, or cash. Was it rational? No. Was it reasonable given their lived trauma? Absolutely. And for them, it worked, because it gave peace of mind. Why reasonable works better? It keeps you in the game. A rational plan that you can't emotionally stick with is useless. A reasonable plan keeps you consistent. It aligns with human psychology. Money decisions aren't made in spreadsheets. They're made in living rooms, marriages, and workplaces. Reasonable decisions account for emotions, fears, and relationships. Ignoring emotions in financial decisions isn't realistic. Embracing them and building a plan around them is reasonable. Stories of reasonable success. The investor who slept well. One investor kept a portion of wealth in low-yield bonds, even though stocks had higher returns. Critics called it irrational, but he said, "Those bonds let me sleep at night, and sleeping at night keeps me invested for the long haul." His portfolio grew steadily because he stayed consistent. The couple who saved too much. A couple lived frugally, saving more than they technically needed. Rationally, they could have spent more, but being reasonable meant saving gave them peace of mind. When an economic downturn hit, they were prepared. Practical applications. Build a plan you can live with. Don't chase the mathematically perfect portfolio if it gives you anxiety. Choose a mix of assets you can stick with for decades. Respect your emotions. Acknowledge that fear, greed, and uncertainty play a role. Instead of fighting them, design around them. Prioritize consistency. The best strategy is the one you can keep using, not the one you abandon at the first downturn. Don't over-optimize. Good enough is often better than perfect. Chasing perfection creates fragility. Closing thought on Chapter 11. In Chapter 11, Housel makes one of his most practical points. When it comes to money, reasonable beats rational. Because financial success isn't about finding the perfect mathematical model. It's about finding the sustainable human plan you'll stick with. It's not about being the smartest investor. It's about being the most consistent one. So don't aim to be a robot with money. Aim to be a human with a plan. A reasonable plan you'll follow for life.
Chapter 12. Surprise. If there's one constant in financial markets, it's this: the future always surprises us. No matter how much data we analyze, how many models we build, or how certain experts sound on TV, the world has a way of shocking us with events no one saw coming. Morgan Housel opens this chapter with a blunt truth. History is not a map. It's just a sample of surprises. And the biggest risks and opportunities are the ones we don't anticipate. Why surprises rule finance? Humans love certainty. We want to believe we can forecast the future if we just study the past. But the financial world doesn't work like that. The stock market doesn't care about your spreadsheet. The economy doesn't move in predictable cycles. The world constantly throws black swan events, things that were unthinkable until they happened. Think about it. The Great Depression, the 1970s inflation crisis, the 2008 financial collapse, and the COVID-19 pandemic. None were predicted with certainty, yet each reshaped the world economy. The greatest financial events in history are always surprises. The danger of overconfidence in history. We study history for lessons, but here's the catch. We assume the biggest risks in the future will look like the risks of the past. But the biggest risks always look different. For example, in the 2000s, everyone feared another Great Depression. Instead, the 2008 crisis looked completely different, a housing collapse fueled by financial engineering. After 2008, investors feared another banking collapse. Instead, the COVID-19 pandemic blindsided the world in 2020. History is useful, but it doesn't repeat. It rhymes with new twists. Story: World War II and the economy. Before World War II, no one predicted that global conflict would end the Great Depression. Yet wartime production transformed the U.S. economy. The surprise wasn't just the war, it was how the war reshaped wealth, technology, and global power. This shows how surprises don't just bring risks, they also create unexpected opportunities. The psychology of surprises. Why do surprises hurt us so much financially? We crave patterns. Our brains are wired to see the past as a reliable guide. We underestimate uncertainty. We think the future is narrower than it really is. We're shocked by the improbable, even though improbable events happen all the time. The result? We're always preparing for the last crisis, not the next one. Accepting the unknown. The antidote is humility. Housel argues, we should expect surprises as normal, not rare. Don't try to forecast every detail. Build financial strategies that can withstand the unknown. Accept that no one, not economists, not investors, not politicians, knows the future. Preparing for surprise. So how do you deal with a world full of surprises? Margin of safety. Always leave room in your finances. Have savings, insurance, and conservative investments to protect against shocks. Flexibility. Don't overcommit to one scenario. Build a plan that works in many possible futures. Resilience over prediction. Stop trying to be exactly right. Instead, make sure you're never destroyed by being wrong. Real-life examples. The 2008 housing crash. Few predicted the exact trigger, but those with savings and diversified investments survived better than those over-leveraged in real estate. The COVID-19 pandemic. Entire industries collapsed, but others like tech, remote work, and healthcare boomed. Those flexible enough to adapt turned surprise into opportunity. Practical applications. Save aggressively. Extra savings are your shield against surprises. Diversify investments. Don't put all your wealth in one asset, one industry, or one country. Expect volatility. Market drops, recessions, and shocks aren't anomalies. They're features of the system. Focus on resilience. Build a financial life that can take punches without knocking you out. Closing thought on Chapter 12. In Chapter 12, Housel delivers a humbling reminder. The future will surprise us, always. The greatest financial events of your lifetime are likely ones you can't imagine today. That's not a reason for fear. It's a reason for preparation. Because success doesn't come from predicting the next surprise. It comes from surviving the surprises you never saw coming. So stop trying to control the uncontrollable. Instead, build resilience, keep flexibility, and let humility guide your path.
Chapter 13. Room for Error. In the world of money, as in life, nothing ever goes exactly as planned. Morgan Housel opens this chapter with a timeless principle. The margin of safety is the cornerstone of financial survival. If surprises, from the last chapter, are inevitable, then the only rational response is to build a cushion, a buffer that allows us to absorb mistakes, shocks, and bad luck without being destroyed. This buffer is what Housel calls room for error. The logic of a safety margin. Think about driving across a bridge. If the bridge is designed to hold 30,000 pounds, engineers don't allow trucks weighing 29,999 pounds to cross. They build for much more, maybe double or triple the expected load. Why? Because life is uncertain. Loads vary, conditions change, and mistakes happen. Your finances work the same way. If you spend 100% of your income, you leave no room for error. If you invest without cash reserves, you expose yourself to ruin. If you borrow heavily, even a small downturn can wipe you out. A margin of safety isn't just a financial tactic. It's a mindset of humility, recognizing that the future is unknowable and our confidence is often misplaced. Story: Ben Graham and the margin of safety. The idea comes from Benjamin Graham, the father of value investing and mentor to Warren Buffett. Graham taught that you should never buy a stock at its calculated fair value. Instead, buy it well below that value. Why? Because valuations are just estimates, and estimates can be wrong. By building in a margin of safety, you protect yourself from uncertainty, miscalculation, and bad luck. Buffett calls this principle the single most important lesson he learned from Graham. Why we struggle with room for error. Modern culture celebrates optimization. Maximize returns, maximize efficiency, maximize productivity. But maximization leaves no room for error. It's like running a car engine at full speed all the time. Eventually, it breaks. People dislike leaving slack because it feels like waste. Why keep cash sitting idle when it could be invested? Why leave free time in your calendar when you could be productive? But what looks like waste is actually resilience. Room for error is the space that keeps you alive when the unexpected hits. The difference between optimism and survival. Housel reminds us, you only have to get rich once, but you can lose it many times. An investor who seeks the highest possible returns without margin of safety might strike gold in the short term, but eventually risk catches up. Survival, not maximization, is the real financial goal. As Housel says, you don't have to be risk-free. You just have to ensure you're never wiped out. Examples of room for error in action. Cash reserves. Families who keep 6 months of expenses and savings sleep better during recessions. They don't have to sell investments at the worst time. Debt avoidance. A business with little debt can survive downturns, while over-leveraged firms collapse when revenue falls. Diversification. Investors who spread risk across different assets can withstand surprises in one sector or region. Personal energy. Even in life, margin of safety matters. Overcommit your time and energy, and you burn out. Leave room, and you adapt better to crises. Story: NASA engineers build spacecraft with redundant systems. If one system fails, another takes over. This isn't wasteful, it's survival. Without backups, a single failure could cost lives and missions. Your financial life deserves the same redundancy. Don't assume everything will work perfectly. Plan for when it won't. The psychology of slack. Leaving room for error requires humility. It means admitting you don't know the future. You aren't as in control as you'd like to believe. And luck and randomness play huge roles in outcomes. Instead of trying to eliminate risk, accept that risk exists and build buffers to absorb it. Practical applications. Keep more cash than you think you need. It feels inefficient, but it's the best defense against uncertainty. Avoid debt dependency. Debt magnifies errors. Keep leverage low. Invest conservatively. Aim for realistic returns, not the highest possible ones. Plan as if forecasts are wrong. Assume markets may fall harder, recessions may last longer, and expenses may rise higher than expected. Build flexibility into life. Time, money, energy. Leave slack in all three. Closing thought on Chapter 13. Room for error isn't about pessimism. It's about realism. The world is unpredictable. Your plans will never unfold perfectly. Without buffers, you're fragile. With buffers, you're resilient. The paradox is this: people who build in room for error often end up thriving, not just surviving. Because when the world surprises everyone else,
they're the ones still standing. So, don't aim to be perfect. Aim to be unbreakable.
Chapter 14. You'll change. Morgan Housel begins this chapter with a truth that is both simple and uncomfortable. You are not the same person you were 10 years ago, and you won't be the same person 10 years from now. Our goals, values, desires, and definitions of success change with time. Yet when making financial decisions, we often assume our future selves will want exactly what we want today. This mismatch creates one of the biggest psychological traps in money, building a financial life for a version of ourselves that no longer exists. The illusion of permanence. Think about your younger self. At 18, maybe your biggest dream was buying a fast car, traveling the world, or living in a big city. At 30 or 40, your priorities may shift toward stability, family, or security. By 60, health and peace of mind might matter more than anything. The problem is financial decisions often lock us into commitments that outlast our desires. A 30-year mortgage assumes you'll want the same house for decades. A retirement plan assumes your future lifestyle will match your current vision. Career choices often assume passions won't change. But people change. The end of history illusion. Psychologists call this the end of history illusion. It's the belief that while you've changed a lot in the past, you won't change much in the future. Ask someone if they're different from their teenage self, and they'll laugh, "Of course I am." Ask if they'll be different in 10 years, and many shrug, "Probably not much." But when you look back later, you see just how wrong you were. Housel argues that financial planning must account for this inevitable evolution of self. Story Daniel Kahneman on life satisfaction. Nobel Prize-winning psychologist Daniel Kahneman once asked people what makes life meaningful. Answers varied: career success, relationships, freedom, health, spirituality. But when he checked in years later, people's answers often shifted. What once felt urgent no longer mattered. New priorities took over. This is normal. Humans grow, adapt, and evolve. The danger is when financial choices are rigid, while life is flexible. Money and the flexibility of desire. Here's the problem. Most financial advice assumes permanence. Save X for retirement, invest for Y years, plan to reach Z goals. But what if you don't want Z anymore? Maybe you planned for a luxury lifestyle, but later crave simplicity. Maybe you invested for early retirement, but find purpose in work. Maybe you chased wealth, but later value relationships more. If your financial choices don't allow flexibility, you may feel trapped by goals you no longer care about. The role of humility. The solution isn't to stop planning. It's to plan with humility. Housel suggests building financial strategies that allow you to adapt as your desires change. That means saving more than you think you'll need, avoiding rigid commitments, valuing flexibility as much as returns. Because the biggest risk isn't market volatility, it's being stuck in a financial life designed for a person you no longer are. Story: Warren Buffett's 20-year-old self. Warren Buffett has lived a remarkably consistent life, but even he admits that many of his goals shifted over the decades. At 20, Buffett cared mostly about making money. At 60, he cared about giving it away effectively. His financial strategy worked because he left room for his changing values. He didn't lock himself into a single definition of success. He built wealth broadly, which gave him choices later. The danger of over-optimization. Some people plan their finances with surgical precision. They forecast expenses down to the penny, project investment returns, and create a rigid roadmap. But life rarely follows a straight line. Over-optimized plans break easily when desires or circumstances shift. Housel suggests aiming not for perfection, but for resilience. Instead of asking, "What's the exact future I want?" ask, "What range of futures might I want, and how can I prepare for all of them?" Practical ways to plan for change. Save more than you think you'll need. Extra savings isn't just about emergencies. It buys flexibility for future desires you can't yet imagine. Keep investments broad. Diversify instead of betting everything on one vision of the future. Avoid irreversible commitments. Don't tie yourself to huge fixed expenses if possible. Flexibility is freedom. Revisit your goals regularly. Every few years, ask, "Do I still want what I'm building toward?" If not, adjust. Accept that regret is inevitable. You'll always wish you had known your future self better. Don't let regret paralyze you. Just keep adapting. Closing thought on Chapter 14. The biggest lie we tell ourselves is that we know exactly who we'll be in the future. But life has a way of reshaping us. Desires fade, priorities shift, goals evolve. The financial danger lies not in change itself, but in refusing to prepare for it. Housel's advice is clear. Build a financial life that embraces flexibility, because the most valuable asset isn't money itself, it's the freedom to change your mind without ruining your future.
Chapter 15. Nothing's free. Money has a cost. Not just the obvious price tags we see on goods or services, but hidden costs that show up in time, stress, uncertainty, and emotional strain. Morgan Housel argues that every financial gain comes with a price, and most of the time, that price is not immediately obvious. The challenge is that while we love the rewards of investing in wealth building, we often want them without paying the true cost. But in finance, as in life, nothing is truly free. The hidden price of investing. Most people think the cost of investing is commissions, fees, or taxes. Those are visible. But the real cost of investing success is volatility, fear, doubt, and uncertainty. You can earn high long-term returns in the stock market, but only if you're willing to endure the roller coaster of short-term losses. If you want the returns of the S&P 500, you have to accept its 30 to 50% declines that occur every few decades. If you want the magic of compounding, you have to pay with decades of patience. This cost isn't paid in dollars, it's paid in psychological resilience. Story: the price of admission. Housel uses a brilliant metaphor. Market volatility is like an admission fee to a great theme park. If Disneyland tickets cost $100, you wouldn't call it a scam. That's simply the price of entry. In the same way, when stocks fall 30%, that's not evidence the system is broken. That's the price of admission to decades of wealth creation. The problem is that many investors treat volatility as a fine to be avoided, rather than a fee to be paid. They try to dodge downturns, time the market, or panic sell, and in doing so, they forfeit the very rewards they seek. Short-term pain versus long-term gain. The stock market has returned roughly 10% annually over the long run, but that comes at a cost. Frequent short-term downturns. Crashes that test your patience. Headlines that tempt you to sell. Those who can't stomach the cost often sell low and miss the rebound. Those who accept the price, volatility as the ticket to long-term wealth, are the ones who get rewarded. Story: the 2008 financial crisis. During the global financial crisis, the market fell over 50%. Millions panicked and sold at the bottom. But those who endured the pain saw their portfolios recover and grow dramatically over the next decade. The price was terrifying uncertainty. The reward was one of the greatest bull markets in history. Nothing valuable is truly free. Think about other areas of life. A healthy body costs discipline, exercise, and restraint. A great career costs years of learning, mistakes, and persistence. A strong relationship costs compromise, effort, and vulnerability. In each case, people crave the reward without the sacrifice. But the universe doesn't work that way. With money, the sacrifice is patience, resilience, and the willingness to endure discomfort. The problem of misunderstanding costs. The tragedy is that many people quit paying the price right before the reward arrives. They sell after a crash instead of waiting for recovery. They abandon compounding because it feels too slow. They chase shortcuts because the real cost feels too heavy. If you misunderstand the fee, if you see it as unfair rather than necessary, you'll never stay in the game long enough to win. The role of perspective. Here's the key. Instead of trying to avoid volatility, reframe it. Don't see downturns as punishment. See them as the ticket to long-term wealth. Don't treat patience as wasted time. Treat it as the investment itself. Don't fight uncertainty. Budget for it emotionally. Once you accept that the cost is unavoidable, you can stop resenting it and start preparing for it. Practical applications. Expect volatility. Don't be shocked by downturns. Plan for them. If markets never fell, returns would be tiny. Budget for emotional costs. Recognize that investing will test your nerves. Build systems like automation or long-term horizons that keep emotions in check. Hold cash as shock absorber. Cash reduces the psychological burden of volatility. It may lower returns slightly, but increases staying power. Think in decades, not days. Reframe market declines as temporary tolls, not permanent losses. Compounding works only across long stretches of time. Treat pain as the price of wealth. Just like gym soreness is the price of fitness, volatility is the price of returns. Accept it, don't avoid it. Closing thought on Chapter 15. The most dangerous financial illusion is thinking you can get something for nothing. Every gain has a price. Every reward demands a cost. The people who succeed with money are not those who avoid the price, but those who are willing to pay it consistently. In Housel's words, nothing worth having is free. The question is only whether you're willing to pay the cost.
Chapter 16. You and Me. Money is personal. It is as much about identity and perspective as it is about math. In this chapter, Morgan Housel explains that one of the greatest misunderstandings in finance comes from forgetting that people play different financial games. What looks irrational to you may make perfect sense to someone else because their goals, circumstances, and time horizons are not the same as yours. This insight is essential. We should not judge others' financial decisions by the rules of our own game. The stock market as a mixed game. Imagine a stadium where multiple sports are being played at the same time. Basketball on one end, soccer in the middle, tennis on the side. The scoreboard shows a mix of scores from all the games. Now imagine you only care about basketball. If you see the scoreboard change, it might confuse you. Why did the score jump like that? But the change came from a soccer goal, not your game. The stock market is the same. Millions of participants are playing different games. Day traders chase short-term moves. Pension funds invest for decades. Hedge funds take leveraged bets. Families save for college. Retirees seek income and safety. When you see wild moves in prices, they often reflect someone else's game, not yours. Story: the dot-com bubble. During the late 1990s tech boom, many long-term investors thought day traders were crazy. Why would anyone gamble on internet stocks with no profits? But for day traders, the game wasn't long-term investing. Their goal was to ride momentum for a few hours or days. It looked irrational from a 30-year retirement perspective, but within their own short-term game, it made sense. The danger is when investors confuse the two. When a long-term investor chases short-term hype or a short-term trader tries to hold like a pension fund. Personal games, personal goals. Housel emphasizes that money is always contextual. A 25-year-old can afford high volatility. A 70-year-old retiree cannot. A billionaire can take big risks for fun. A middle-class worker cannot without jeopardizing security. The problem comes when we borrow strategies, advice, or benchmarks from people playing completely different games. The media problem. Financial media thrives on this confusion. Headlines scream about daily market moves, but for long-term investors, those moves are irrelevant. Experts debate hot stocks, but those debates may matter only for traders, not savers. When you consume financial news without context, you risk playing a game you never intended to play. Story: the 401k investor versus the trader. Consider two investors. Sarah, a teacher, steadily contributes to her 401k for retirement 30 years away. Mike, a professional trader, makes dozens of trades a day based on technical patterns. Both are smart. Both make rational decisions. But if Sarah copied Mike's trades, she'd destroy her retirement. And if Mike copied Sarah's slow and steady strategy, he'd fail at his job. The key lesson: rationality depends on the game you're playing. The danger of envy. Comparing yourself to others is another trap. If your neighbor doubles their money in crypto overnight, you may feel foolish sticking with index funds. If a coworker flips houses and makes a quick fortune, your steady savings may seem boring. But what you don't see is their risk tolerance, their time horizon, or whether their strategy is sustainable. Envy tempts us to abandon our own game and join someone else's, often with disastrous results. Story: the poker table analogy. Imagine a poker table where some players are professionals, others are casual gamblers, and others are just learning the rules. Each person plays differently. If you copy someone without knowing their goals, whether they're playing for fun, for practice, or for profit, you'll likely lose. The stock market is a poker table with millions of players. Don't assume you're playing the same game as everyone else. Building your own game plan. The solution is clarity. Define your own financial game. Identify your time horizon, goals, and risk tolerance. Stick to your rules, even when others play differently. Once you know your game, other people's strategies stop distracting you. Practical applications. Define your time horizon. Are you investing for 5 years, 20 years, or 50 years? The right strategy depends on the timeline. Filter advice by relevance. Before following financial advice, ask, is this person playing the same game as me? Ignore noise. Daily market moves are someone else's game. Focus on your own long-term path. Resist envy. Just because others win in their game doesn't mean you're losing in yours. Revisit your game regularly. As your life changes, your game changes. Update your strategy accordingly. Closing thought on Chapter 16. The biggest mistake in finance is assuming everyone is playing the same game. They're not. Some are sprinting, some are running marathons, and some are just jogging for fun. The challenge and the opportunity is to clearly define your own game, then play it without distraction. Housel's wisdom reminds us, you don't have to win at someone else's game. You only have to win at yours.
Chapter 17. The Seduction of Pessimism. Optimism builds wealth. Pessimism sells. Morgan Housel argues that while optimism is the most realistic stance for long-term investors because progress is the historical norm, pessimism feels smarter, more persuasive, and more realistic in the moment. This chapter explores why negative news grabs our attention, why it feels more credible than optimism, and how this bias shapes our financial decisions. Why pessimism sounds smarter. If someone says things will get better, it sounds vague and naive, but if they say, here's why disaster is coming, it sounds analytical, precise, and intelligent. Humans are wired for survival. Bad news signals danger, so we instinctively give it more weight. In finance, this means pessimistic forecasts, market crashes, recessions, collapses, often attract more attention than positive outlooks. Story: The Great Depression's Shadow. The Great Depression of the 1930s left a deep scar on an entire generation. For decades afterward, many people avoided stocks, distrusted banks, and feared debt. Even as the economy grew, their pessimism overpowered optimism. This shows how powerful negative experiences can be. One deep scar can overshadow decades of steady progress. Short-term pessimism versus long-term optimism. Here's the paradox. In the short run, pessimism often proves correct. Markets do crash, recessions do happen. In the long run, optimism wins. Despite wars, crises, and downturns, economies grow, innovation continues, and wealth compounds. The challenge is that short-term pessimism drowns out long-term optimism. Investors abandon strategies that would have worked beautifully if given time. Story: Warren Buffett on America's future. Warren Buffett often reminds audiences, in my lifetime, America has faced world wars, recessions, inflation, pandemics, and political turmoil, yet the Dow Jones rose from 66 to over 30,000. That's optimism grounded in history. Short-term pessimism made sense during each crisis, but long-term optimism was the winning bet. Why we crave doom stories. Survival instinct. Paying attention to threats kept our ancestors alive. Novelty bias. Progress is slow and compounding, but disaster feels sudden and dramatic. Status of the pessimist. The person warning of disaster often seems wise and cautious, while optimists risk looking naive. The media amplification. Media outlets exploit this bias. Headlines about crashes, bubbles, and doom grab more clicks than stories about steady growth. Markets may crash, spreads faster than markets likely to rise slowly. Recession ahead goes viral, while steady expansion expected gets ignored. This constant pessimism can discourage people from investing, even when long-term odds are overwhelmingly in their favor. Story: The missed opportunity of the 1980s. In the early 1980s, America faced high inflation, unemployment, and political turmoil. Many believed the U.S. was in decline. Yet those who ignored pessimism and invested in the stock market enjoyed one of the greatest bull runs in history. The cost of pessimism? Missed opportunity. Balancing realism and optimism. Housel isn't saying ignore risks. He's saying learn to distinguish between short-term noise and long-term progress. Short-term pessimism is often accurate. Long-term optimism is almost always correct.
The trick is to survive the short term without abandoning the long term. The psychology of fear versus hope. Fear feels urgent. Hope feels patient. That's why investors panic sell during crashes, but rarely panic buy during recoveries. We are more motivated to avoid loss than to pursue gain, a principle psychologists call loss aversion. This explains why pessimism seduces us. It feels safer, but in reality, it often leads to worse outcomes by keeping us out of the very progress that creates wealth. Practical applications. Zoom out your time horizon. When headlines scream disaster, remember, long-term charts show steady progress. Filter media noise. Recognize that pessimistic headlines are designed to grab attention, not guide strategy. Expect crises as normal. Treat downturns, recessions, and crashes as the admission price for long-term wealth. Study history. Remind yourself how often pessimists were wrong in the long run. Optimists tend to look foolish in the short term, but wise in the long term. Anchor in optimism, prepare with prudence. Be optimistic about the long run, but realistic about volatility. Keep room for error while staying invested. Closing thought on Chapter 17. Pessimism will always sound smarter, safer, and more sophisticated. Optimism will often sound naive, but history tells us the truth. Progress is the default, growth is the norm, and wealth belongs to those who endure short-term pessimism without losing long-term faith. Housel leaves us with this wisdom. Optimism is the best bet for most people because the world tends to get better most of the time.
Chapter 18. When You'll Believe Anything. Money isn't just numbers, charts, and strategies. It's also about stories we tell ourselves. In this chapter, Morgan Housel explains how humans create financial narratives, sometimes true, often false, to make sense of a complex world. These stories give us confidence and direction, but they can also blind us to reality. Why we rely on stories. Humans crave simplicity. The financial system is incredibly complex, with countless variables moving at once. To cope, we reduce uncertainty by telling stories. Instead of saying, markets fluctuate due to millions of interdependent factors, we say, the market is going up because of interest rates. Instead of admitting no one knows the future, we latch on to predictions that sound convincing. Stories help us feel in control. They calm our fears in an uncertain world. Story, the dot-com bubble. In the late 1990s, the internet was transforming the world. Investors told themselves a story. Every company with a website will change the future. People poured billions into startups with no profits, no products, sometimes not even a real business plan. The story was compelling and partially true. The internet did change everything, but the narrative blinded people to reality. Not every dot-com company would succeed. When the bubble burst, trillions of dollars vanished. Yet notice, the core story wasn't wrong, only over-applied. This shows the power and danger of stories. The comfort of certainty. We prefer a clear story, even if it's false, over the messy truth. Example. This stock will make me rich feels better than this stock might rise or fall for reasons no one fully understands. The economy is doomed feels more certain than the economy is complex and outcomes vary. Certainty sells. That's why financial gurus, market prophets, and doom predictors attract loyal followings. Why we believe even false narratives. Cognitive biases. We cherry-pick evidence that fits our story. Social proof. If everyone around us believes the story, we assume it's true. Emotional comfort. Hope and fear drive belief more than logic. Hindsight bias. After an event, we rewrite stories to make it look like it was obvious all along. Story, the housing bubble, 2000s. Before the 2008 financial crisis, millions believed housing prices never fall. That story was comforting. It justified risky loans, over-leveraged banks, and homeowners buying more than they could afford. The reality? Housing prices can fall, and they did, devastating millions of families. The belief in the story was so strong that it blinded both experts and ordinary people. Narratives drive markets.
Housel emphasizes markets don't move just on fundamentals, they move on stories. In booms, people believe in progress, innovation, and endless growth. In busts, people believe in collapse, danger, and doom. Reality is somewhere in between, but narratives drive decisions in the short run. The problem with oversimplification. Stories simplify complexity, but oversimplification can distort reality. For instance, stocks always go up is true in the long run, but false in the short run. Debt is always bad, sometimes true, but debt can also fuel productive growth. Markets are rational. Neat story, but markets are often driven by emotion. When simplified stories replace critical thinking, mistakes multiply. Story: Sir Isaac Newton's investment failure. Even the smartest minds fall prey to seductive financial stories. Sir Isaac Newton, one of history's greatest geniuses, invested in the South Sea Company in the 1700s. The story around the company was irresistible. Britain's future prosperity lies in global trade. Newton invested early, made a profit, sold, then re-entered the market as the frenzy grew. The bubble burst, and Newton lost much of his fortune. He later lamented, "I can calculate the motion of heavenly bodies, but not the madness of people." His downfall? Believing a story too strongly. Why stories stick better than data. Housel notes, people rarely remember statistics, but they remember stories. Example: a report saying markets grew 7% annually is dull. A story about a janitor secretly building a fortune through steady investing inspires action. That's why stories, true or false, spread faster and influence behavior more deeply than raw numbers. Practical applications. Question the story you're believing. Ask, does this narrative oversimplify? What's left out? Look for contradictions. If a story feels too perfect, search for evidence that challenges it. Beware of overconfidence. Just because a narrative makes sense doesn't mean it will come true. Use stories wisely. Stories are powerful teaching tools. Use them to inspire discipline, but don't let them blind you to reality. Separate hope from strategy. It's fine to be inspired by narratives of success, but your financial plan should rely on data, history, and diversification, not just storytelling. Closing thought on Chapter 18. Humans are storytelling creatures. We believe anything if it reduces uncertainty, comforts us, or gives us hope. But the real discipline lies in recognizing when stories are guiding us toward truth and when they're leading us astray. Housel reminds us, the more complex the world becomes, the more tempting it is to reduce it to simple stories. But reality is always more complicated than the stories we tell ourselves.
Chapter 19. All Together Now. Morgan Housel has spent the book giving us 18 separate lessons about money, behavior, and psychology. In this chapter, he ties them all together, showing how they interconnect into a coherent philosophy for building wealth, living wisely, and staying sane in a noisy financial world. This is not about complex formulas or perfect predictions. Instead, it's about developing a mindset that balances humility, optimism, and discipline. Money lessons are not just financial. Housel stresses, money lessons spill into life lessons. The way you handle uncertainty, risk, and decision-making with money often mirrors how you deal with relationships, careers, and personal growth. Understanding this connection helps us see money not as a separate domain, but as a reflection of how we think and act. Story: the pilot and the checklist. Airline pilots use checklists before every flight. Why? Because even the most skilled aviators are human, prone to error. Similarly with money, no matter how much we know, we need systems and reminders. Otherwise, emotions take over. This chapter acts as Housel's financial checklist, a way to keep ourselves grounded when fear, greed, or overconfidence tries to hijack our decision-making. Big themes pulled together. Here are the major ideas Housel weaves into one framework. Luck and risk are unavoidable. Success is never fully deserved. Failure is never fully earned. Luck and risk shape outcomes more than skill alone. Enough is the key to happiness. The pursuit of more often destroys peace of mind. Knowing when you have enough keeps you from reckless risk-taking. Compounding is the eighth wonder. Time and patience beat brilliance. Wealth comes not from one great decision, but from consistency. Freedom is the ultimate goal. Money isn't about luxury, it's about control of your time, autonomy over your life, and freedom to say no. Room for error protects you. Optimism about the future must be paired with prudence in the present. A margin of safety keeps you in the game long enough to benefit from compounding. Pessimism sounds smarter, but optimism wins. Short-term fears will always dominate headlines, but long-term optimism is historically the winning strategy. Stories shape reality. We act on narratives, not numbers. Being aware of the stories we tell ourselves can keep us from delusion. Story: the investor who quit too early. Imagine an investor who starts at age 25, invests diligently for 10 years, then quits at 35, thinking, "I've done enough." Now imagine another who doesn't start until 35, but invests until 65. The first, despite quitting early, often ends up richer because compounding had more years to work. This simple story captures the essence of the book. Time, patience, and discipline matter more than timing or brilliance. Humility plus endurance equals wealth. Housel argues that success with money comes down to two qualities. Humility, admit you don't know everything, that luck plays a role and that the future is uncertain. Endurance, stay invested, keep saving, avoid catastrophic mistakes, and let compounding do its work. Put together, humility keeps you from overreaching, and endurance ensures you actually benefit from long-term growth. Story: Charlie Munger's wisdom. Charlie Munger, Warren Buffett's longtime partner, once said, "The first rule of compounding is to never interrupt it unnecessarily." This is exactly what Housel emphasizes. Survival is the name of the game. If you can stay in the game, even modest strategies build great wealth. But if you get wiped out by debt, greed, or overconfidence, compounding never has a chance. Practical checklist for money. At the end of this chapter, Housel effectively gives us a checklist that brings all the book's lessons into one frame. Aim for independence, not status. Use money to gain control of your time, not to impress others. Be reasonable rather than rational. It's okay to make decisions that aren't mathematically optimal, but help you sleep at night. Plan for surprises. Build room for error into every plan. Assume volatility, downturns, and setbacks are inevitable. Stay humble in success, resilient in failure. Neither outcome is fully earned, both are shaped by luck and risk. Invest with a long horizon. Forget day-to-day noise. What matters is staying consistent for decades. Be wary of stories. Remember that humans crave simple narratives. Step back and ask, does this story really match reality? Recognize enough. Chasing more endlessly is the surest path to ruin. Story: the farmer who survived droughts. Think of a farmer. Each year, he plants crops, knowing some seasons will bring drought, floods, or pests. He can't control nature, only his preparation. If he plants diverse crops, keeps reserves, and works steadily, he survives bad years and thrives in good ones. Investing works the same way. You don't need to predict every storm. You just need a system that keeps you alive through the storms so you can benefit from the sunny seasons. The psychology over the math. By now, Housel's thesis is crystal clear. Money success is not primarily about intelligence, math, or strategy. It's about behavior. Can you control your greed in good times? Can you stay calm in bad times? Can you define enough and live by it? These questions matter more than predicting interest rates, GDP, or stock prices. Practical applications. Create your personal financial checklist. List rules that protect you from emotion-driven mistakes, like "I won't sell in panic," or "I'll always keep 6 months of expenses in cash." Anchoring your why. Remember that money is a tool for freedom, not just accumulation. Define what freedom means to you. Automate discipline. Automate savings and investments so decisions don't depend on daily news. Focus on longevity, not perfection. You don't need to be the smartest investor. You just need to avoid ruin and let time do its work. Review and reflect. Periodically revisit your financial story. Ask, am I chasing status or freedom? Am I building resilience or gambling? Closing thought on Chapter 19. All together now is Housel's reminder that money is not about finding the perfect trick, but about combining timeless principles, humility, patience, optimism, prudence, and self-awareness. If you remember nothing else from the book, remember this: money success is less about what you know and more about how you behave.
Chapter 20. Confessions. After 19 chapters of lessons, Morgan Housel closes his book with something different, a personal confession. He admits up front he doesn't follow every financial principle he's laid out. Why? Because money is not just about rational optimization. It's about what works for you. This chapter is part humility, part transparency, and part reminder that personal finance is indeed personal. The core confession.
Housel confesses that although he knows the math behind diversification, index funds, and long-term investing, he still holds a large percentage of his money in cash. Why? Because it helps him sleep at night. Cash provides peace of mind, flexibility, and security, even though, in purely rational terms, it's not the highest return asset. This is his way of practicing the book's theme. Being reasonable is better than being perfectly rational. Story: The role of cash in a crisis. Think of the 2008 financial crisis. Banks collapsed, unemployment spiked, and people panicked. Those with all their wealth tied up in investments faced sleepless nights, but those with some cash reserves felt secure. They weren't forced to sell assets at the worst possible time. For Housel, cash is like insurance. It may not maximize growth, but it protects peace of mind and prevents panic-driven mistakes. The importance of self-awareness. Housel stresses that everyone has different financial needs, fears, and goals. What works for him, holding extra cash, might not work for someone else. The deeper point: knowing yourself is more valuable than copying someone else's strategy. Some people crave growth. Others crave safety. Some want adventure. Others want stability. There is no single right way, only the way that aligns with your values and psychology. Confession beyond cash. Housel shares that he doesn't try to beat the market. He doesn't invest in trendy stocks or chase maximum returns. Why? Because he doesn't need to. His goal isn't to be the richest person. It's to live comfortably, avoid financial stress, and control his time. That's the hidden confession. Money is not about maximizing wealth. It's about maximizing life satisfaction. Story: The Two Neighbors. Imagine two neighbors. One earns $500,000 a year, but spends $490,000. He has little freedom, always stressed, always chasing more. The other earns $100,000, but spends $50,000. She has freedom, security, and peace of mind. Who is wealthier? The confession here is that wealth is not absolute. It's relative to needs, lifestyle, and values. The danger of copying others. Housel warns, copying someone else's financial plan without understanding their background, goals, or psychology is dangerous. Warren Buffett's strategy works for Warren Buffett, not necessarily for you. Your friend's crypto gamble may suit his risk tolerance, but not yours. Your parents' obsession with saving might reflect scars from past recessions, not your reality. His confession highlights that the most successful financial plan is the one you can actually stick with. Why he prefers simplicity. Another confession: Housel's own investments are boring. He avoids overthinking, avoids frequent trading, avoids complex financial instruments. He prefers simplicity, predictability, and patience. This goes against the exciting stories we hear of hedge funds, day traders, or stock-picking geniuses. But boring works. As he puts it, I'd rather be reasonable and sleep well than be brilliant and anxious. Story: The Surgeon Who Burned Out. A surgeon Housel once met earned millions, but his investments were complicated: private deals, leveraged bets, and exotic assets. The result: he was constantly stressed, checking markets, losing sleep, and feeling trapped. Meanwhile, ordinary workers with steady 401k index funds quietly accumulated millions without drama. The surgeon optimized for returns. The ordinary investor optimized for peace. Guess who was happier? Practical applications from the confessions. Define your own goals. Don't copy someone else's financial strategy. Ask, what do I value most? Freedom? Growth? Security? Sleep test. If an investment strategy keeps you up at night, it's wrong for you, even if it looks great on paper. Keep cash for peace of mind. Cash may not maximize returns, but it maximizes flexibility and reduces panic during crises. Simplicity beats complexity. A simple plan you stick to will outperform a complex one you abandon. Don't confuse rich with wealthy. Being rich is earning a lot. Being wealthy is having control, freedom, and peace. The final message. Housel closes with humility. He doesn't have all the answers, and he doesn't follow every principle perfectly. But that's the point. Money is personal. The right financial plan isn't about maximizing spreadsheets. It's about aligning money with the life you want to live. His confession reminds us to stop chasing the best plan and instead pursue your best plan. Closing reflection on Chapter 20. The book ends where it began, with behavior, not math. You don't need to be a genius to build wealth. You don't need perfect predictions. You don't even need to follow every rule perfectly. What you need is humility, self-awareness, patience, and discipline. As Housel confesses, even the author of a book on money chooses comfort over optimization. And that's okay, because money is only a tool. The real goal is a life well lived.
And there we have it. The Psychology of Money by Morgan Housel, explored chapter by chapter, lesson by lesson. This book has taken us on a journey, not through formulas, stock charts, or complicated theories, but through the human side of money. We've learned that financial success is not about IQ, but about behavior. It's about humility in the face of luck and risk. It's about knowing when you have enough. It's about letting time and compounding do the heavy lifting. It's about protecting yourself with room for error while keeping faith in long-term optimism. And above all, it's about remembering that wealth is not what you see, but what you don't spend. The freedom, flexibility, and peace of mind money gives you. Morgan Housel reminds us that money is deeply personal. What works for one person may not work for another. There is no universal formula, only principles to guide us and the wisdom to adapt them to our own lives. So, what's the final takeaway? Money is not the ultimate goal. It is only a tool. The real goal is freedom. The freedom to live on your terms, to spend your time as you wish, and to define your own version of enough. As you move forward, remember, be patient, be reasonable, stay in the game, and use money to serve your life, not the other way around. Thank you for joining me on this journey through the psychology of money. If this audiobook-style summary inspired you, don't forget to subscribe to Audio Growth Library for more deep dives into the world's most powerful books on self-development, wealth, and wisdom. Until next time, take control of your money so you can take control of your life.